Section 3, Detailed Financial Statements. In this section, we're going to expand on what we've done. We've seen the outline of what the balance sheet, the income statement, and the cash flow statement do and how they interact. We're going to look now in more depth at how the numbers work, how the numbers can be calculated, and some of the assumptions behind some of the valuations. We're going to come back to the accrual concept and go into more detail. We're going to do some calculations of cash flows, and then we'll conclude with this section with some double entry bookkeeping. I did say you're not going to need to know that, but I'm going to show you what it does and how it works. Here is a balance sheet in a bit more detail. When we introduced this in an earlier section, I already described the assets, liabilities, and equity. Let's go through at least the assets and liabilities quickly, and then we'll explore the equity in a bit more detail. So assets, these are positive things the company owns. You've got cash in the bank. You've got accounts receivable, money owed by customers, also known as trade debtors. What you tend to find where you've got these multiple terms, you've got typically the British English term, in this case it's trade debtors, and the accounts receivable is more international. Now in most scenarios we're going to talk about receivables and payables rather than debtors and creditors, but you should know the different terms, you should know what they mean, and that they are for the most part synonymous. Inventory, this is the stock sitting in the warehouse. Again, I'm not going to use the word stock because although stock is quite commonly used for inventory, it has plenty of other uses as well, such as common stock, shares of common stock, which we'll come on to. So inventory in this case is what we use. It's unambiguous. It is stuff ready to sell, or it's work in progress, or right at the beginning of the manufacturing process, it's the raw materials. But it's all inventory that we have bought. It's stuff that at some point will be turned into things that we're going to sell. And prepaid expenses as well. We have seen that was the rental example where we had a $90,000 prepaid expense on the balance sheet. That was called prepayment. Again, you pay in advance for something that we haven't benefited from yet, so it's money on account, if you like. That would be equivalent with the rent example. Instead of having 90,000 still sitting in our bank account, we had prepaid the landlord for the rent. And so we had this asset, which was 9 months prepaid rent. And so that's all a current asset. So current versus non-current assets. How do we distinguish between these two groups? Current assets, for the most part, are those items that are to do with the everyday manufacturing of items that we're selling. So you've got, for the most part, cash, receivables, inventories, and other things which are turning into cash or which we're getting benefit from within an operating cycle. An operating cycle is how long it takes from when we buy inventory and turn it into a good that we can sell it, and get the cash into the bank. So the operating cycle is basically how long to do a full transaction. And current assets are those items that will turn into cash within one operating cycle. Non-current assets are longer term. Now, sometimes you use the distinction between less than 1 year and longer than 1 year to generate cash, though for the most part, most analysts will say that current assets are defined by category, by classification, rather than by timing. Non-current assets are those assets used in the ongoing functioning of the business. So property, plant, and equipment. These are assets that the company owns, and although they may buy and sell them, that's not the trade of the business. So a company may well buy a property, may buy a machine, may buy a computer that it's going to use for 4 years. That's not inventory. That's a non-current asset called property, plant, and equipment. Another term for that is tangible fixed assets. You may have come across tangible fixed assets. Long-term investments, these are essentially shares in other companies. So you buy shares in other companies, then you benefit if they make profits and if they grow over the years. Now that's quite a complex accounting method. We'll actually see quite a few different methods depending on how many shares we own. That is not a topic here, but that's something that we will see in fact in the CFA program at level 2. So it's quite a big topic there. Intangible assets, these are assets that have no physical substance. You can't hit them, you can't touch them. And they are things like patents, brands, copyrights, licenses. There's something also called goodwill, which we're not going to go into detail in this course. But goodwill is if you pay a lot of money for another company because the value, the perceived value of that company is more than its balance sheet, then goodwill arises. Now, I'm not going to go into the details of that, but you should be aware that goodwill is one of the main categories of intangible assets. and it arises when one company purchases shares in another company. On to the liabilities. Current and long-term. This is much stricter. So current liabilities are very much those that we have to pay within 1 year, and longer term in more than 1 year. So whereas the current and non-current assets are generally by classification, the liabilities are done by timing. How long before we need to make these payments? So that we're going to have to pay them, we're going to have to settle these amounts. You have an overdraft, and although you may have had an overdraft for many, many years, but the fact that the bank has the right to call the overdraft in at any time, the bank can say to you, we want the money back now, we're withdrawing our overdraft facility, you need to pay us back within a day. Now that'd be pretty harsh for them to do it, but legally they are entitled to do that. Accounts payable or trade creditors, we owe our suppliers money. So the payables, amounts that we have to pay to our suppliers for goods that we have bought but not yet paid for. Once again, this is an example of the accrual concept, and we will see this more and more times, in fact, over this and the next section, that the accounts payable, the fact that we have purchased goods and not paid for them, accounts receivable on the other side, the fact that we have sold goods and not received payment for them, that leads to accruals, which are differences between the cash flow statement and the income statement, and we will look at that in more depth later. Accrued expenses. Likewise, we have incurred costs that we haven't yet paid for. It's a bit like accounts payable, but it's everything else. Accounts payable, specifically, we have bought things from our suppliers. Accrued expenses, we have incurred, let's say we're paying rent in arrears. We've incurred some rent but haven't yet paid for it. We have incurred some costs within the business, some restructuring costs, some other costs that we're putting through an accrual for. That means we are putting in an expense which is going to hit the income statement, but it hasn't yet been paid for. So that is a liability. I think of a liability as something that we're probably going to have to pay for. If you have put through an expense through the income statement, it means the business has reflected it, but we haven't yet paid for it. Tax payable, if we owe the government money, there could be dividends payable if we owe the shareholders, and anything else that needs to be paid within a year. Longer term is anything due in more than 1 year. So long-term debt and leases. So long-term debt. We could have borrowed from the bank for 10 years. It may well be that we've borrowed from the bank for 10 years to repay in 10 equal installments, in which case 1/10 of that would be a current liability if it's due within a year, and 9/10 would be long-term debt. And then leases, as I mentioned earlier, you're using an asset on a long-term contract. You're using an asset on a long-term contract, and the lease is saying that you've committed to payments for a number of years into the future, and that the lease obligation there is what we owe in more than 1 year's time. The lease obligations again could be current as well. So those are the liabilities. As described, your total assets minus your total liabilities equals equity. Equity is also known as shareholders' funds. So shareholders' funds, stockholders' equity, they mean the same thing. Shareholders' funds may be a bit more British, stockholders' equity is a bit more international. They mean the same thing. It is the book value of the equity in the company. So shareholders' funds, now this breaks down in a number of ways. I'm going to break it down first of all into two components. Shareholders' funds, this is how the business has been funded, how the net assets have been funded. Remember, total assets minus total liabilities, which is the same thing as net assets, equals shareholders' funds. That's your fundamental accounting equation that we've seen. Now, shareholders' funds consists of two things. You've got money paid in by shareholders, and you've got all the accumulated profit since the company was incorporated. So money paid in by shareholders can be described as common or preferred shares. So shares of common stock, shares of preference stock, shares of preferred stock. And they differ fundamentally by saying that preferred shares get preference over common shares, hence their name, and preferred shares get a fixed dividend each year. So if you own a preferred share, it will say you have, let's say, a 5% share, and for every $100 of that, you're going to get $5 dividend per year. Now, it's not guaranteed, but it does get preference over common. If you own the common shares or ordinary shares, again, ordinary is more British, common stock is more international, then you get whatever the directors allow you to get. So they will announce a dividend for common shareholders, and if they say 1 year we're not paying dividends, then they don't pay dividends. If they say 1 year we're paying a very big special dividend, then good for you. So dividends are going to be either almost guaranteed for the preference shares, the preferred shares, or completely variable for the common shares. And this is a topic for another time, but preferred shares therefore look a bit like what mathematically is called a perpetuity. You're getting regular cash flow year after year after year. The common shares, you're getting what you hope is going to be a steadily increasing dividend. And when it comes to dividend policy, managers generally try to create a policy where the dividend gradually rises by a few percent every year. That way it's stable, it's predictable by shareholders, and that helps push the share price up. So if you own shares in a company, you almost certainly own the common shares. Preferred shares are relatively rare, relatively uncommon. In fact, if you look through the Financial Times pages of all the share prices, you will find that there are a very small handful of preferred shares. Very few companies indeed these days use them. Common shares are much more common. So that's the money paid in by shareholders. Then you've got the retained earnings. So retained earnings, we've already seen how that fits together, especially how retained earnings is the sum since the company was incorporated of all the profits the company has ever made and not paid out to shareholders. So each year, as we saw, the company's net income is split. Some is paid as dividends, maybe none, but some of it may be paid as dividends, and the rest is retained on the balance sheet in this account called retained earnings. So please don't confuse the retained earnings for the year, which is on the income statement, and that feeds into this amount, retained earnings here, which is cumulative since the company was incorporated. So retained earnings on the balance sheet is cumulative. And this is what you'll find with the balance sheet. It grows or it shrinks, but it's the cumulative position of the company. If in a year the company does very little, the balance sheet will stay stable. So the balance sheet is representing what's happened since the company started. The income statement and the cash flow statement start from zero every year. On the 1st of January, you start from zero on those two statements. Now, there are a number of questions we need to ask ourselves regarding the balance sheet. We've already seen a choice when it came to depreciation policy. So let's now look at some other choices, and we'll explore these in a bit more detail later in the course, but I just want to put the questions now so that you can start to see some of the choices faced by the managers. Accounts receivable. Let's suppose you're owed $1,000 by each of 100 customers. So you have $100,000 accounts receivable. Are they all going to pay you? Well, realistically, probably not. Some will default. Some will fight. They'll say, we don't owe this money. Some will go bankrupt. And so in practice, what managers need to do is to be prudent. It's a bit aggressive. If you say we're going to get 100,000, it's unrealistically optimistic. So even though they're owed 100,000, they're probably not going to get all that in. And so it's prudent to say we're going to put a provision against some of that amount, and it could be 2%. So let's say we show 98,000 instead of 100,000. It could be 5%. We show 95,000 instead of 100,000, and that's being a little bit more realistic. It's saying we know there are going to be a few problems with some of our customers. Let's put in this provision. Now, how much provision depends on the management opinion. It could be the market has taken a turn for the worse and we think there are going to be more defaults. It could be management want to make a bit more profit this year, which is not a good reason to change it, but they may say, well, we're going to reduce it from 5% to 2%. And so instead of being owed 95,000, instead of showing 95,000, we show 98,000. So accounts receivable, even something as simple and seemingly objective as how much money do customers owe us, there's still this bit of subjectivity when it comes to showing the number on the balance sheet. Inventory. This is quite a big topic. Inventory. Let's suppose we hold inventory for maybe half a year. So let's suppose we buy raw materials, we turn them into widgets and we sell them. And by the time we sell them, we've had that in inventory for 6 months. So when it comes to the year end, what inventory do we put on the balance sheet? Is it the items that we've bought in the last few months? Or are we selling the items that we've bought in the last few months? So we have two main methods for dealing with inventory. In fact, there are a few others as well. But we have FIFO and LIFO, first in, first out, and last in, first out. So first in, first out says that it's a conveyor belt. Think of the long conveyor belt. We buy goods, they sit as raw materials, they're manufactured into finished goods, and they sit on the shelf and then they're sold. And if that's taking 6 months, then it takes 6 months. So it means that you buy them, what you buy in January so it's sitting in raw materials in January, turns into finished goods in July, that's what we sell. Now, bear in mind, this is only an accounting transaction. We don't really know which precise items are sold in July. It's an accounting assumption. Let me try something else. Let's say we have a warehouse system. We're making widgets that never go off. Yeah, so widgets are lumps of metal and wood, whatever they happen to be, and as a result, they have an indefinite shelf life. What if you make your widget, you throw them into the shelf when you've made them, and then when you come to sell them, the person who works in the warehouse picks out the one from the front of the shelf to sell it. So imagine that scenario where what you're selling is the most recent item that you've put in the warehouse. So as you make items, you put them into the warehouse at the front because that's the easiest place to put them. And when you're selling them, you pick them off from the front because that's the easiest place to collect them from. And if they've got an indefinite shelf life, it doesn't make any difference which widgets we're selling, because the ones at the front of the shelf and the ones at the back gathering cobwebs, they may be 10 years old, but they look the same because they don't have a limited shelf life. Now that is called LIFO. The most recent items added last in are the first items that we sell, first out. So those two methods, although it is only an accounting calculation rather than what really happens, they can make a difference, because if you've got inflation, your figures are going to be different. If you've got inflation, the most recent items that you bought are going to be more expensive than earlier items that you bought. And you'll find that if we're using LIFO and FIFO, it changes your financial statements. For example, with LIFO, if you're selling what's at the front of the warehouse, at the front of the shelf, then what's left at the back could be 10 years old and therefore bought 10 years ago and therefore lower price. So it affects both your balance sheet in terms of inventory and your income statement in terms of COGS, the cost of the goods that you're selling. So that's a question to be posed. Property, plant and equipment. We've already talked about how long the computer is going to last, 2 or 4 years. So how long will each asset remain in use? How quickly do the values fall? Now, with the example we did, we said it goes from $1,000 down to 0 in 4 years. I gave another example where we bought a machine for $10,000 and that drops in 10 equal decreases down to 0 over 10 years. But imagine if you've got something technological. Let's go back to our computer. If we're going to use it for 4 years, what's it really worth after 1 year? It's really worth a lot less. So you could actually draw a graph here. So instead of saying, I'm going to write what's called net book value. That's the carrying value of the asset, and here's time. So net book value. If the computer is going to start at 1,000 and drop down to 0 over 4 years, then it's going to fall by 250 each year. But if it's a computer, then realistically, after the first year, it's not worth anything like 3/4 of its original value. And so you have other methods of depreciation which come down faster in the early years, and that's called accelerated. And we'll describe that later on briefly, but the idea of accelerated is you're dropping in value faster in the early years, and then it slows down later in the life of the asset. So different methods of depreciating property, plant and equipment. There are other questions as well, such as salvage value, that you may want to put in a salvage value. Again, something to think about. Intangible assets, I've already described, I've already given a list of some of them. How are they calculated? Can you think of debatable components in them? So if you think, for example, about, let's say we have a patent. Now there are two scenarios here. We buy a patent on a particular item and that's going to give us value for 10 years. Or we create a patent and we register it with the Patent Office. So two different scenarios. One of them you may treat as an asset. So we're buying this patent, it's cost us $1,000 and we're going to what's called amortize. That's like depreciation. We'll amortize it at a tenth of its value every year. Or we create the patent with our patent lawyers, our patent specialists, and we file it, in which case we're just using our existing staff costs. So in one scenario, it may be better to put it on the balance sheet as an asset. In another scenario, it may be better just to treat it as an expense as we create it. And the shape and size of the income statement and the balance sheet are very different afterwards. So it's quite a big decision. Other components of intangibles, how on earth do you measure them sometimes if you've created a brand? If you're buying a company, remember this is where goodwill arises. How much are you paying for that company? If you pay such a large amount, you've paid such a huge amount, so the shareholders of that company have now walked away with loads of cash because you paid too much for it, then is that purely an investment or have you simply spent too much? These are debated questions and they're going to lead to differences how we show them on the financial statements. Should all leases be shown as liabilities? What if we're using, let's say we're using a computer but we're paying monthly for it and every month we have the right to cancel it and send it back to get an upgrade? Then that's not a long-term commitment. But if I use a computer, let's say, and it's going to last for 4 years and I'm committed to 4 years of payments, and at the end of its 4 years I can give it back to the shop that leased it to me and they're going to say, you may as well keep it, it's not worth anything, then can you see that's equivalent to me buying it using hire purchase. I'm buying it using some form of financing. And the accounting for that differs. So if I have a lease that is committed for most of the asset's life, then that's going to be what we call a finance or a capital lease, and that needs to be shown as a long-term liability. If I have another lease, it may well be that I don't show it as a liability. And again, the balance sheet will be very different under these two choices. So you've got the finance lease and you've got the other one which is called an operating lease. And they are structured very differently, and often management will structure a lease so that it falls under one category rather than the other. Typically, management want to use operating leases rather than finance leases, and that's because you don't need to show the liability. So again, it's controversial. If you didn't quite follow that, don't worry, it'll make more sense later on. But understand for now, there are questions that need to be answered, and there are a lot of subjectivities when it comes to how we put the accounts together. So go back to my first class, learning Accounting 101. This is genuinely a dark art, and our objective as analysts is to uncook the books and to try and work out what is the true story behind the numbers. Let's look at the income statement. I would say less controversial, but it's not. There are plenty, anything that affects the balance sheet is likely to affect the income statement as well. So we've seen one version of the income statement. Here's another with a little bit more complexity to it. So let's go through some of the numbers that we haven't looked at. We've seen revenues and COGS. Revenues minus COGS give you gross profit. We then saw operating expenses, including depreciation, removed, and that gave us operating profit. Now, I said that was similar to EBIT, but there are some items that go in between the two. These items we can see now are called unusual or infrequent items. Now, English term is they're called exceptional items. Exceptional items. Now, these are items that are sufficiently uncommon or big, or then they need to be shown separately to give the analyst a true understanding of what's going on. So we made a sale of part of the business in the year, or we changed our operations in a major way, or there was a transaction that was so substantial that without separating that transaction, you don't get a feel for the rest of the business. So those are examples. And when it comes to this, you need to show them separately so that the analyst and the reader of the accounts can choose whether to include them or not. And often what you find is companies will put things into unusual or infrequent items because they don't want them to be part of the gross profit or the operating profit. And in many cases, one of the objectives of managers, if you want the accounts to look as good as possible, then positive items you want to put further up and negative items you want to bring down. So for example, if you have a choice between an item of revenue and an unusual and infrequent item, the income statement looks better if you show it as revenues. If you have a cost that's sufficiently unusual, and it can either be an operating expense or unusual or infrequent, again, it looks better to be under unusual or infrequent, because if you put it lower down, the operating profit will be a bigger number. So just try to understand the mathematics of this. You've got various subtotals here. You've got the gross profit, the operating profit, you've got EBIT, and each time, if you take a positive number and push it up as far as you can, or a negative number and push it down as far as you can, you're making the subtotals look better than they might otherwise be on a purely objective basis. So unusual and infrequent items, in fact, one little test you can do is if you think a company is making has too many unusual or infrequent items, what you do is you look at their accounts this year, you download their accounts from last year and look at unusual and infrequent, and the year before, and the year before. And if you look back over the last 5 or 10 years, and you may find similar items appearing every single year, just ask yourself, how unusual is that transaction really? So you get a feel for what management are trying to achieve on this. But unusual and frequent items, we need to be able to look at them separately. We certainly need to have the choice of what to do with that number. So we as analysts may say, well, let's put it further up, but that's our decision. Shouldn't really be for managers to decide. You've then got EBIT that we've seen and financing costs, but then things go a bit different. You've then got, instead of pre-tax earnings, which is what we had before, we've now got pre-tax earnings from continuing operations. And what's happened is we have stripped out discontinued operations. Let's suppose we sell off part of the business in the year. So that part of the business had revenues, it had COGS, it had operating expenses. What you're doing is the whole of the income statement down to this line here. So all of the top part of the income statement is relating to continuing operations. So if there's part of the business that we sold halfway through the year, then the revenues will not be shown in the revenue figure here. The costs will not be shown in the income statement either so far, because they're separated out, so that once we get to net income from continuing operations, it's just showing what's happened from the part of the business that is still there at the year end. In other words, if you've got part of the business that was discontinued in the year, you remove the revenues, the COGS, the operating expenses, even the interest. Every component of discontinued operations is separated out, is separated from the rest of the business, and it goes in as a single number down the bottom after tax. So in other words, there may have been some revenues from this discontinued operation, there may have been some COGS and some operating expenses. All of the numbers further up in the income statement have had that component removed from it. So they've been reduced in size, even most of the numbers. And then the net income is separated between the continuing operations, and then a single number, income from discontinued operations, is put in there to give us the overall net income at the bottom. So net income at the bottom is what we would expect. It's net income for shareholders at the end of the year, including everything the business has owned during the year. But anything that was sold during the year, all the discontinued operations have been separated into a single number. So that's a little bit more detail on the income statement. And hopefully you've now got a feel as well for the fact that managers are making decisions, and they do have influence over where particular numbers, especially costs, go. And it does make a difference to some of the subtotals. So let's come back to the accrual concept, and let's do some more examples. So think about the earnings process, revenues and expenditure, and the cash flow in the following situations. So what we've got two boxes at the bottom, and I'm going to use both of these boxes 4 times. So you may just want to do 8 of these boxes. So you've got the 1 pair there, you may just want to do 6 more, so 3 more pairs underneath if you're making any notes. And what we're going to do is for each of these 4 transactions, we're going to do a pair of them. So goods are sold to a customer in late December. What I'm going to do for the first time is we're going to put in that transaction where the good is sold, and then we're going to see what happens when the cash is paid. So let's begin. So goods are sold to a customer in late December, offering a month's credit. It may be worthwhile if you pause this and just think. So as I'm speaking, before I give you the answers, just press pause on the video and just think, where do I think this is going to go? So goods are sold to a customer, offering a month's credit. Think what that does. Press pause and just contemplate that for a moment. So we're going to look at each of these 4 in turn. I'm not looking at inventories here. I'm focusing on the cash versus the accruals, the cash, the earnings side, and we're going to be seeing accounts receivable and accounts payable. So the first one, goods are sold to a customer. Now, at that point in time, the fact that we've made the sale means you're going to have a bit of retained earnings going up. There's the profit components. We're showing the transaction. It applies to this year, but you have an account receivable that appears because we haven't got the cash. Then next year, after the year end, you've got your accounts receivable balance that's sitting there at the moment, and when the customer pays, that then drops and cash comes into the bank. So we're going to have, these are 2 balancing transactions. I mean, they're not going to be, I haven't put any numbers in, but the balance sheet will always balance. And the first one, we sell goods to a customer and we're going to be reflecting the profits. You can see retained earnings there, and you can see it's gone. We have an account receivable. We haven't received the cash yet, so you show it in receivables. And then next year, this is reversed, and we have the account receivable dropping because we're now getting the payment from that. And if you're owed $1,000, as you get the money in, your cash goes up by 1,000 and your receivable goes down by 1,000 because you're not owed 1,000 anymore. So that's the first transaction. Let's do the second transaction. Goods are purchased from a supplier in late December, also on credit. So now we're spending money on something. So we're buying goods. This time it's on credit, so accounts payable goes up. And given that it's an expenditure, let's put that in retained earnings going down. So we've spent some money. We've bought something which is going to hit the income statement. Again, I'm ignoring the inventory. Let's say it's an expense of something. So you've shown the expense and you've shown the fact that we owe the money. Now, next year, beginning of next year, you have an account payable sitting there on the balance sheet. Next year, we pay the supplier. And so cash drops by that amount, and the account payable drops as well. Can you see it balances? They're on opposite sides of the balance sheet, and therefore they move in the same direction. When we had an account receivable, the receivable went, when we received the money, the receivable went down and the cash went up, offsetting each other. They were both assets. Here, you've got cash on the one side and you've got the payable on the other side, and they both move in the same direction so that the balance sheet continues to balance. So in this case, when we make the payment in January, the cash goes out from the bank and the account payable disappears. Number 3, a customer pays in advance for goods that won't be ready until January. So let's say it's Quartic and we receive a client receipt. So we invoice a client and receive some cash in December for a course that isn't happening next year. So what's happened isn't happening until next year. So cash goes up this time. So what does that mean? Have we earned the money yet? Just think, has the earnings process happened? We receive in December a payment for a course that begins in January. So we've received payment in advance, but the course hasn't happened yet. And the revenue relates to the actual course taking place. So the course hasn't happened yet in December, so you do not show revenue or any income. Therefore, retained earnings is not going to be affected. So how do we do this? What do we do? Cash has come in. What you do is you show what's called prepaid income under liabilities. Prepaid income goes up. Now, what does that mean? Now, first of all, they offset the balance sheet balances. Prepaid income says that we owe them not cash, but we owe them the course, we owe them the service. So cash goes up, offset by liability, we owe them that product. and therefore that's how the balance sheet looks. In the following year, you've got your prepaid income sitting there, and then what happens when we run the course, the liability disappears and the revenue goes up. So we then reflect in earnings and revenues the course that we've now taken, that's now run. We show in retained earnings the course that has run, so revenues and retained earnings, and the liability disappears. We did have prepaid income, that's, you can see the downward arrow, that's now dropped because we've now provided what we owed them. And again, an up and a down arrow, both on the right-hand side of the balance sheet, they will cancel each other out. Finally, number 4, rent is paid in December for the first quarter of next year. So this time, cash drops, and we've already seen what happens with the previous example. We have the prepayment, which goes up. So there's our prepayment, and then and they offset each other. So whatever the rent is that's paid, that's both the cash downward movement and the prepayment up. And then at the beginning of the following year, you have your prepayment. So in the following year, that is going to disappear, and the offsetting part of that is the expense in the income statement. So as we use the rent up, so if you paid it for a quarter, over the quarter, you're saying, well, we prepaid the rent and we're now using it. So it's an expense in the income statement, it reduces retained earnings, and your prepayment drops down to 0. So those are 4 examples of the accrual concept. Try to get your head around it. I know it's quite complicated, and I mean, even these, I've simplified these transactions to try and demonstrate how they work. But understand that when we're looking at transactions, the equity or the retained earnings is going to move as we earn money or as we spend, as we incur the expense, and the cash moves as cash comes in and cash goes out. And any mismatch in those two, which happens for all 4 of these, will result in a current asset or a current liability, whatever makes the balance sheet balance. And if you take those simple building blocks, it should make life a lot easier. So step 1, have we earned money or incurred the expense? If so, your retained earnings goes up or down. Step 2, have we received or paid cash? That goes into the bank, cash at bank. And then step 3, put an arrow or whatever makes it work. So a current asset or a current liability, whichever one you need to make the balance sheet balance. Let's have a look at the cash flow statement now in a bit more detail. We've seen that your 3 subdivisions of cash flows are operations, investments, and financing. And we already saw that those 3 effectively reconcile the year-end cash position to the start of year cash position. What we need to do is let's go into a bit more detail and see what goes where in more depth. So first of all, CFO. CFO, cash flows from operating activities. This is most of the transactions. If you look on the bank statement, all cash from customers, all cash payments to suppliers, most of what's going on during the month, during the year, fall under CFO, operating cash flows. Inflows from customers, outflows to suppliers, payment of operating expenses, payment of taxes. So it's really, most things go there. It's almost easier to remember what goes into CFI, what goes into CFF, and everything else goes into CFO. CFI are the investing cash flows, and this is long-term assets and long-term investments. So PP&E, property, plant and equipment, and long-term investments. The purchase of those, which is going to be a negative CFI, and the sale of those, which is a positive CFI. So if you buy a machine, let's say a machine is purchased for $10 million, it'll be CFI of minus 10 million. If at the end of its life you sell it for scrap for, let's say, 1 million, then it'll be CFI plus 1 million. So cash outflows are going to give us a negative CFI, cash inflows will be a positive CFI. And that applies to property, plant and equipment, or intangible assets, or long-term investments. Cash flows from financing activities are shares and bonds. If we issue shares, we sell shares to the public, CFF, positive financing cash flows. If we borrow money from the markets by issuing a bond, again, CFF upwards. If we then repurchase the shares, so we're buying shares back from the market, or we redeem a bond, then it's going to be CFF downwards, negative CFF. So those are your three categories. You just need to remember what goes into those three. Now, there are a few complications here, and that is that when it comes to things like interest and dividends, there are choices. US GAAP and IFRS treat these differently. Just to tell you what the differences are, and unless you're going to become an accountant or an analyst, you don't need these. But what the rules say, under US GAAP, if you want to get a full list, under US GAAP, interest payments and interest receipts are CFO, dividend receipts are CFO, and dividend payments are CFF. So interest in, interest out, and dividends received are all CFO, and the last one, dividend payments, are CFF. That's under US GAAP. Under IFRS, dividends and interest received can be CFO or CFI. Dividends and interest paid can be CFO or CFF. So under IFRS, you have a choice. US GAAP is much more prescriptive. IFRS, you have a choice, and all four cash flows, interest in, interest out, dividends in, dividends out, can all be CFO. But the receipt of dividends and interest can also be CFI, and the payment of dividends and interest can also be CFF. If you need them, great. If not, just move on. Let's do an example. If you're given a list of cash flows, literally what I want you to do with each of these is write CFO, CFI, or CFF next to each one of these, put a plus and minus, and work them out. So for each of these, can you put CFO plus, CFO minus, or CFI or CFF plus or minus? Have a go at that now, add them up and see what you get. So just pause now until you've done that calculation. Let's go through those. Hopefully you've got the same numbers as you can see on the screen now. Cash receipts from customers. This is operating cash flow and it's a positive cash flow. So CFO plus. Payment to suppliers is a negative to cash outflow, but it's also operating. Sale of old machine, that's a positive, that's an inflow from investments, cash inflow from investments. Purchase of new machine is cash outflow, so negative CFI. Payment of salaries is operating cash flow, it's cash out. New common stock shares sold, we're selling shares, which means cash comes in, so positive CFF. And we're paying tax, that is CFO, that's going out. And if you add those up, your operating cash flows are plus 920 minus 530, so plus 920 minus 530 minus 220 minus 70, and that comes to 100. If you look at CFI, you've got the purchase and sale of the machines, 230 and 390. 230 coming in, 390 going out, leaves you with minus 160. And then CFF, you've just got the share sale, which is plus 150. Hopefully you got that. Just a useful little exercise for you. Let's now have a look at where we can get those cash flows from. So if we're trying to work out the cash flows, then if I tell you, here, this is cash receipts from customers, then that's easy, that's your answer. But let's suppose I don't tell you cash receipts from customers, but you need to try and work it out. Now, there's a way of doing this from the balance sheet and the income statement. So let's think about what numbers we have in the balance sheet and the income statement relating to cash receipts from customers. Now, first of all, why is cash coming in from customers? Answer, they've bought things from us, we've made sales, they owe us money, they're paying us for it. So our first guess, what are cash receipts from customers, has to be sales or revenues on the income statement. Because if all customers paid us what they owed, then that would be almost exactly right. So sales on the income statement gives you our first guess of cash receipts from customers. Now, we need to go into a bit more detail than that because not all of this year's sales paid us. So let's use the numbers here. We had sales of 1,000, but at the end of the year, we had 140 in accounts receivable. So that means of this 1,000, not all of it paid us in the year. In fact, 1,000 minus 140, only 860 of that 1,000 was received. So that 140 has not yet come in. That will hopefully come in next year, but that needs to be deducted from the 1,000 to work out how much of this year's sales were received. So answer 1,000 minus 140. Offsetting that, last year we were owed 120, and let's assume they all paid up this year. We hope they paid up in early January. So let's say they all paid up. So we received 120 of cash from last year's sales. So in other words, we received from this year's sales 1,000 minus 140, but from last year's sales we received 120. In total, that comes to 980. Now you can see the working down here, down the bottom left. 1,000 we received this year, plus 120, which is what we collected this year from last year's sales, minus 140, which is the component of the 1,000 that we didn't collect this year, and that adds up to 980. Now, there is a shortcut. The 1,000 is our first guess. Have a look at accounts receivable. If that had been stable, let's say it was 120 last year and 120 this year, then the cash receipts would also be 1,000. So it would be 1,000 plus 120 minus 120. But because receivables went up from 120 to 140, look at the direction of that. It went up by 20 in the year. Where is that money? Our customers owed us 120 last year and 140 this year. Where is that money? Answer, it's in their bank account, not ours. So how's that for cash? Well, it's not very good, is it? So in other words, relative to last year, we are $20 worse off. And the accounts receivable, the movement in accounts receivable, the increase by 20, means that relative to all else the same, $20 that we should have is still with our customers. And so that's a negative cash adjustment. Now, there's a big shortcut here, and that's by using the balance sheet diagram. On the balance sheet diagram, you can see accounts receivable have gone up by 20, therefore cash has to go down by 20. They're both under assets, the balance sheet needs to balance, and therefore the adjustment for accounts receivable, they must move in the opposite direction. Receivables down, cash up, or in this case receivables up, cash down. They must move in opposite directions. So let's just do the opposite. If receivables have gone down, it would mean we're better off for cash. We've managed to collect more money this year. So in this case, receivables went up. We're worse off in cash terms by 20. Therefore, our cash collections were 1,000, which is our first guess, minus that 20 adjustment, gives us 980. That's how we do it. That's how we work out the cash flow from the balance sheet and income statement. Let's try the other one out, the other way around. Let's try cash payments to suppliers. So we made purchases in the year of 600. We had accounts payable last year of 70 and this year of 80. So what was our payment this year? First of all, let's start off with the 600. That's a cash outflow. So we purchased, therefore our first guess is we paid 600. The amount at the end of the year of 80, we didn't pay. We haven't yet paid that. So that's a positive cash impact. But the 70 that we owed last year, we have to say we did pay. So last year's payables we have now paid. They're not going to let us hold on to the money for more than a year. So we paid that 70. We didn't pay 80 of the 600. And so our overall payment is we paid 600 and we paid another 70 but didn't pay 80. And therefore minus 600 because it's a cash outflow, minus 70 because we paid the money for last year's payables, plus 80 because there's 80 that we haven't paid at the year end from this year's purchases. And overall that gives us 590, negative 590 because it's cash payments. So the shortcut here is payables went up by 10. Last year we owed 70, this year we owe 80. Payables went up by 10. Where is that 10? We owe 10 more at the end of this year compared to last year. Where's that money? Answer, in our bank account. That's good news. And so it's a positive cash adjustment. So accounts payable go up, which is what this is. It's a positive cash adjustment. Here you go. Accounts payable up 10, cash up 10. In other words, the more money we owe other people, the more money is still in our bank account. That's good news. It's good news until they start getting the lawyers at us, throw the lawyers at us. But you can see that in terms of the cash adjustment, an increase in payables is good news for cash because that's money we haven't yet paid. And so the shortcut for this is your purchases in the year are 600. There's a cash outflow of 600. The payables have gone up by 10. So that's a positive cash adjustment of 10. So minus 600 plus 10 is minus 590. And that's how it works. That's how we've worked out the cash payments to suppliers. Now this we can do really with, this is sort of more generic if we want to include other current assets, other current liabilities. There's no reason why we can't do something very similar. And you can see the adjustment here, non-cash asset. So in other words, the accounts receivable is the example. The cash moves in the opposite direction because the non-cash asset and the cash are on the same side of the balance sheet. And so they must offset each other in movement. And so if receivables go up, cash goes down. If receivables go down, cash goes up. A liability moves in the same direction as cash because liability is on the right-hand side and cash is on the left, and therefore they move in the same direction to make it balance. So if liabilities go up, we owe more money, more cash in our bank account. If liabilities go down, it means we've paid more money, so less cash in our bank account. They move in the same direction. So that's a useful little summary of how we get the cash flow adjustment from the movement in the balance sheet. So that's the cash flow adjustment from a change in the balance sheet. Note that you need last year's balance sheet as well as this year's balance sheet to do this calculation. Let's conclude this section with a mention of double entry bookkeeping. Now, we're not going to do double entry bookkeeping in this course. There are plenty of bookkeeping courses I'm sure you can find. This is not that course. But what it works with debits and credits. So if you see debits and credits mentioned, it's saying these are the two sides of the transaction. Now, debit is sometimes abbreviated as DR, credit is abbreviated as CR. And the way this works is the debit represents positive items on the left of the balance sheet, so assets. Credits represent positive items on the right of the balance sheet, i.e. liabilities and equity. Now, the way this works, if you think about what goes into equity, the equity includes the whole of the retained earnings, and the retained earnings includes the whole of the income statement. And so the income statement means you've got revenues and costs, and they're also within the debits and credits framework. So roughly speaking, if you make something bigger on the left, it's debit. If you make something smaller on the left, it's a credit. If you make something bigger on the right, it's a credit. If you make something smaller on the right, it's a debit. So let's just do an example. So transaction 1, we buy a machine on credit. So the machine goes up. So that's going to be debit PP&E 800, credit accounts payable 800. So both numbers get bigger. So debit PP&E, credit accounts payable. They've both gone up by 800. When we make the payment, you go debit payables because you're making a number on the right smaller, and then credit cash, you're making a number on the left smaller. You generally put the debit first and then the credit, which is why we did the payables first for the second transaction, because that's where the debit is. You're making the right-hand side number smaller, so it's debit payables. Note that's offsetting. We had credit payables in the first transaction, then debit payables in the second transaction. They offset each other. And so that is how, that's roughly how this works. The way I always remembered this is your debits are on the left, your credits are on the right, and if you're in England, of course, you drive on the left, you crash on the right. That doesn't work in America, by the way, but debits and credits are the same way around. Let me summarize the debits and credits. Your debits, you've got all your assets. Your credits, you've got all your liabilities. You've also got the capital, so paid in capital is a credit. But you've also, within retained earnings, think about retained earnings. Now you don't put retained earnings on this because that's part of what's left of the income statement. Anything positive on the income statement makes that right-hand component bigger. So Equity gets bigger, which is credit, but with more revenues. So revenues goes under credit, and all your expenses go under debit. And that's roughly how this works. So your debits are your assets and your expenses. Your credits are your liabilities, your capital, and your revenues. And although that may seem very illogical, it's how it works. The system has been around for 500 years, and it has worked ever since it was created back in whenever it was, the 16th, 15th century. And we're not changing it now. So that's your double entry bookkeeping. We're not going to learn any more about it than that, but hopefully that gives you just the rough idea of how this starts. The Quartic diagram that we have already used, and we're going to use more, will see us through this course, and that's going to give us hopefully everything we need to get the understanding necessary to get to grips with accounting. But that's the end of this third section.